Two people walk into the same bank building today and sign the exact same loan paperwork with the same interest rate and the same terms. One walks out poorer, the other walks out richer. The deciding factor is not their income, their credit score, or some private banking connection. It comes down to a single question the wealthy ask before the ink dries. What does this money produce before I give it back? We are taught a very specific story about debt, that it is a one-way street of money permanently leaving your pocket to pay a lender. Take a look at this flow map. It shows how the institution actually operates. They take your deposited savings, pay you a 4% yield, and lend that exact same money to someone else at 10%. They permanently keep that 6% gap in the middle. The entire financial structure of retail banking relies on you sitting blindly on the wrong side of that math, acting as the prey that funds their profits. You can step to the other side of the table by buying a business that already pays for a town debt. Right now, there are highly profitable businesses being sold simply because the owners want to retire, and the SBA 7A loan program exists to let you acquire them without needing millions in cash. This chart breaks down a typical $500,000 acquisition. You put down a small $50,000 segment, and the bank funds the massive $450,000 remainder. Because the business is already working, its monthly revenue flows in and steadily shrinks the bank segment, generating a massive cash-on-cash return for you. You can run a much faster version of this by drawing on a 9% business line of credit to pay your suppliers early. If capturing a standard 2% early payment discount takes 20 days, repeating that cycle throughout the year translates to a 36% annualized return. At this level, you stop treating interest rates as a penalty. You are actively using the bank's own liquidity to manufacture a lucrative spread for yourself. You can take this a step further and remove the bank completely. When a seller has owned a highly appreciated property or business for decades, taking a lump sum cash payment creates a devastating immediate capital gains tax liability. Look at this 1959 Schedule D tax form. It highlights the historical and ongoing reality of capital gains liabilities. Under IRS installment sale rules, if a seller spreads your payments over time, they only pay tax on what they receive each year. You offer them a tax-efficient exit, and in exchange, they act as your personal bank at favorable rates. You can also flip the dynamic and step into the role of the lender. Real estate investors renovating properties need short-term capital fast, much faster than traditional banks move. You lend them the cash on a 6 to 12-month timeline and charge a 12% yield. Your capital is tightly secured by the physical property itself, meaning if they fail to pay, you hold the legal right to foreclose on the underlying real estate. By directly solving a seller's tax problem or funding a real estate investor's timeline, you step entirely into the position of the institution. You stop paying the interest and start collecting it. The imposing facade of the IRS building is a reminder that the most powerful wealth strategies are written directly into the tax code. If you or your spouse document enough hours to qualify as a real estate professional under IRS rules, you unlock the ability to claim unlimited paper losses through property depreciation. By using accounting techniques to front-load those depreciation losses into the early years of owning leveraged rental properties, you can offset a high W-2 salary. The bank's money buys the properties, but the properties absorb your income tax bill. We can see another quiet mechanism in this split-screen graphic. Wealthy families use permanent life insurance policies to build a cash value pool on the left. When they need capital, they create a separate loan pool on the right, using their cash values strictly as collateral. Notice how the left pool keeps expanding, because the borrowed money comes from the insurance company's general fund and not your policy. Your original capital continues to compound completely uninterrupted. The most aggressive posture is tummeting the bank's own bad debt. When a homeowner stops paying their mortgage, the bank wants that non-performing loan off their books, eventually selling it to investors for 40 to 65 cents on the dollar. At this stage, the debt itself becomes an asset you own, providing the legal leverage to either modify the borrower's terms or seize the underlying property to secure your return. If we pull back from all these specific methods, we find a single mathematical heartbeat driving every single one of them. This visual isolates the math that makes the entire system function, borrowing at a lower rate to deploy at a higher one, while you retain the gap. The percentages hold steady, whether you are scaling a $15,000 spread or a $1.5 million acquisition. The dividing line between the working class and the wealthy is simply the knowledge of how to operate that exact equation. Look at this classic mid-century bank interior. It proves the institution has been asking, what does this money produce, about your deposits for generations. Understanding these mechanics turns the next loan you sign into a strategic tool for growth, putting you in control of the same mathematical spread the bank has used for years.